The third model market is monopolistic competition. The name of this type of market suggests that some of its characteristics are like competitive model and some of them are like monopoly. First, there's a suggestion that this market model has some tendencies towards monopolistic behavior, that is exclusivity and being able to control the amount of production and charging higher prices. The second part of the name of this model suggests just the opposite, that there are many firms and there's little control over prices. Let's see what characteristics this model market actually has associated with it. Monopolistic competition has four characteristics. There are a significant number of sellers in the market. The word significant means that there are fewer firms than one might find in a purely competitive market, but many more than one would find in a monopoly. Unlike pure competition, where it is easy to talk about thousands or tens of thousands or hundreds of thousands or millions of firms, or a monopoly where there is just one firm, it is difficult to put a precise number on the number of firms in a monopolistic competitive firm, and the economists will often define it in terms of market share. 2. The products sold by monopolistic competitive firms are similar, but not exactly the same. Economists use the term differentiated to mean that products have similar characteristics but not exactly being the same. For example, of differentiation in products might be pizzas. There are several national chains like Little Caesars, Domino's, and Pizza Hut, as well as many small local companies. Each pizza place sells pizzas, but each has its own slight differences in taste and in quality. The products are the same, but are also different. Unlike perfect competitors, monopolistic competitors need to engage in advertising and promotion because the firm sees its product as being different, and the firm needs to inform the consumer about these differences. 4. Entering into a monopolistic competitive market is relatively easy. For example, to start a new pizza restaurant, the entrepreneur needs to purchase a building or rent a building, a pizza oven, and obtain the necessary permits, all relatively easy to do. Let's see how monopolistic competition compares with the other two market models. The number of firms in a monopolistically competitive market is fairly large. Each firm in the market has a relatively small market share. Secondly, each firm lacks the ability or is unable to collude or work with other firms to fix prices and quantities, and makes all of its decisions independent of what other firms do. The product produced by a monopolistically competitive firm is slightly different from those of its competitors. By altering the characteristics and other attributes of their products, they are also slightly different. An interesting question: how does the firm tell consumers about the difference between their product and another firm's product? Advertising and promotion are used by monopolistically competitive firms to communicate the difference between two products. The three types of advertising a firm can use is direct marketing, which is advertising where the seller directly contacts each potential client individually. The message that the seller uses is tailored to individuals based upon census data and other characteristics that the seller knows about the buyer. For example, firms use letters, email, telephone calls to directly communicate about a product to potential buyers based upon average income of a zip code. Mass marketing, there's a single message for a variety of potential buyers. For example, the same commercial can be run on television during a movie, a football game, or a talk show, or the news. Interactive marketing is when the potential buyer can choose whether or not to view the information about the product. This type of advertising is found on the World Wide Web when one uses a search engine. For example, suppose an individual is searching for reviews on tablet computers. The search engine will not only bring up the reviews linked to only reviews, but links to the manufacturer's website and places to buy the tablet. Signaling is a gesture or action which is designed to signal or to communicate information to the consumer about a product which is not generally apparent from the item itself. For example, an attractive individual driving a sports car in an advertisement signals to the potential customer that driving the car will make them more attractive and carefree. Advertising is important, especially for some types of goods. Let's look briefly at the different types of goods that may or may not need advertising. A search good is one where the characteristics of the good can be easily accessed before it is purchased. Purchasing electricity or natural gas is an example of a search good. Chocolate, candy, or a particular flavor of ice cream might also be examples. Experience goods are those goods which must be tried before they are purchased. Clothes are an example of goods that need to be experienced by some people before they're purchased. Food products may also be considered experience, especially if the consumer is thinking about purchasing a new food product. Credence goods are those goods which the public lacks expertise to access the usefulness without assistance. Medicines and medical procedures are goods for most people that need assistance in selecting for a good outcome. The demand curve for the monopolistic competitor is downward sloping like that of the monopolists. The reason is that the monopolistic competitor, in order to sell more of the good to increase total revenue, must decrease the price of the good. Suppose a monopolistic competitor who sells 2 cell phones for $150 apiece. The firm's total revenue is $300. However, the firm would like to make more money. How could the firm earn more money? The monopolistic competitor could increase the price of its cell phones to $301 and could sell 1 phone. Thus, its total revenue would be $301 more than it had when it sold 2 phones at $150 apiece. Let's see, however, what would happen if the firm decided to drop the price of its cell phone by $25. The monopolistic competitor drops its price to $125 and sells 3 cell phones. The total revenue generated by the new price is price 125 times the quantity produced 3, giving a total revenue of 375. So is it in the best interest of the firm to increase the price to $301 or to drop the price to $125? Since the goal of the firm is to make more money, it seems that it's better to drop the price than to increase it. Before comparing the monopolistic competitor with the perfect competitor, let's take a moment to see why the marginal revenue curve is downsloping and below the demand curve. That is, marginal revenue is less than price. As you may remember, our monopolistic competitor decreases the price in order to sell more of its product. Also remember that the marginal revenue is the difference in total revenue divided by the difference in total production. The formula that is commonly used is TR2 minus TR1 divided by TP2 minus TP1. So if we apply the formula to our example of our cell phone company, the marginal revenue from when the monopolist decreases the price of its cell phones from $301 to $150 is $51. Notice that $51 is less than the new price of $150. When the monopolistic competitor decreases the price of the cell phone from $150 to $125, the marginal revenue is $25. Once again, $25 is less than the new price of $125. And this would be the case every time we decrease the price, the marginal revenue would be less than it. Thus, the marginal revenue curve of the monopolistic competitor, like that of the monopolist, is below the demand curve, and marginal revenue is less than price. Let's compare the demand curves, the marginal revenue curves, and the price of the monopolistic competitor and the perfect competitor. The perfect competitor has a horizontal demand curve, which means that demand is perfectly elastic or infinitely elastic. The demand curve is also the marginal revenue curve, and price is equal to marginal revenue. The monopolistic competitor has a downward sloping demand curve, and the marginal revenue is below the demand curve. The fact that the marginal revenue curve is below demand implies that the marginal revenue earned by the monopolist is less than price. As you may remember, the perfect competitor generally produces at the minimum point of the average total cost curve, ATC, on the graphs. Looking at the graph on the left of the screen, you will notice that the demand for the monopolistic competitor touches the average total cost curve to the left of the minimum point of the average total cost curve. The explanation for this situation is that the cost of product differentiation and advertising causes the monopolistic competitor to have higher average total costs. Monopolists and monopolistic competitors have similar demand curves for the same reason. That is, in order to gain customers and by extension total revenues and profits, they need to drop their prices. Monopolists and the monopolistic competitor also share a marginal revenue curve which is below the demand curve and less than price. For example, a monopolist or a monopolistic competitor produces 100 goods. If a line is drawn from the quantity, 100 units, in our example, to the marginal revenue curve and then to the demand curve, the line hits the marginal revenue curve before the demand curve. Also, the lines are drawn from where the line from the quantity axis crosses the marginal revenue curve and the demand curve to the price marginal revenue axis. It's easy to see that marginal revenue is less than price. Before talking about the difference in the demand curves, it's useful to review a bit about elasticity. As you may remember from an earlier video, price elasticity measures the percent change in the quantity demanded divided by the percent change in price. More specifically, an economist want to know what happens to the quantity demanded when the price of a good increases or decreases. Let's say that the price of a good costs a customer $10 and the customer is willing to buy 100 units of the good. So on the graph, down a line from $10 and draw a line from the price axis to the demand curve and then from the demand curve to the quantity axis, in our example 100 units. Now suppose the price of the good increases to $15. The amount of the good that consumers are willing and able to purchase declines to 97, while the quantity of the good has declined only a little bit. This good is price inelastic because the decline in quantity compared with the increase in the price was small. Let's see what happens when the demand curve is flatter or more horizontal. Once again, let's start with the good having a price of $10 and the consumer is willing to buy 100 units of the good. So on the graph, go down to the $10 mark, draw a line from the price axis to the demand curve and then from the demand curve to the quantity axis, and once again an example crosses the quantity axis at 100 units. Now suppose that the price of the good increases to $15. The amount of good that consumers are willing and able to purchase declines to 10 units. Notice that the quantity has decreased dramatically to 10 units. This good is price elastic because the decline in quantity compared with the increase in price was very large, and thus is referred to as being price elastic. While monopolists and monopolistic competitors both have downward sloping demand curves, they are not identical. Monopolists have a relatively inelastic demand curve. This means that monopolists can increase the price of their product and suffer only a small decline in the quantity demanded. The practical reason for this situation is that the monopolist, as you may remember, produces a good for which there is no close substitute. Thus, if the consumer needs the good and there are no close substitutes, the person is unlikely to stop consuming the product. For example, the price elasticity of electricity increases, individuals will likely to continue to consume it despite the additional cost. Monopolistic competitors have a relatively elastic demand curve. This means that the monopolistic competitors cannot increase the price of their product and expect that demand will decline just a little bit. Instead, they face a situation where a small price increase can cause a big decline in the quantity demanded by customers. The reason for the elastic nature of the demand curve is that there are close substitutes for the good. For example, a company that provides cellular telephone service has an elastic demand curve in most major urban markets because there are many competitors willing to have the subscriber's business.